Okay, folks, welcome back. So we're looking at price action model number 10. This is a swing trading model, and we're going to be dealing with setups that we stalk for 50 to 75 pips. Now, obviously, as I'll discuss when we just go into the details of this model, it's not limited to 50 to 75 pips. And you can use it to make smaller amounts of pips, but you can obviously make it form fit a larger position model. Okay, so that's why I elected to use the swing trading model as the label for this one, because it's not something that you are going to be limited to. As you'll see, it's a really simple model. It's easy, I believe, to see in price action, and I think it'll really resonate with a lot of you. If it doesn't, don't feel, like you don't have it together or you're not up to speed with everything. It just means that this isn't your model. So if you are in that category, the first time you watch it, come back to it in a couple months. You can probably warm up to it that way. But I think that the parameters are really simple. It's a really cut and dry approach to looking at price action. You all understand the components because it's very similar to what we've shown in previous models. And with that, let's just get right to it. All right, so we have the ICT price action model number 10. It's a swing traders model. We're stalking 50 to 75 pips per week. The stage for this model is obviously weekly range expansion. So we're always trying to trade in that directional bias. And the setup is going to be day of week specific. And the pattern is going to be external range liquidity runs. All right, so obviously with weekly range expansions, we're going to be identifying the likely or most probable direction the next weekly bar or candle will expand in a directional sense. In other words, if we're looking at a weekly chart, the present or next week's candle, we're trying to derive whether or not the probability suggests it's going to go up or down. The day of week, we're going to be expecting an anchor point to form on a Monday, Tuesday, or Wednesday in order to frame a trade setup. And the pattern is going to be external range liquidity, and we're utilizing external range liquidity pools to facilitate an entry in the direction of the weekly expansion and exiting on opposing external range liquidity pools. All right, so if you look at this chart here, this is an example of external range liquidity pools as entry and external range liquidity pools as an exit. The market has a run above a short-term high in an existing bearish scenario. Now this is the British pound, and I'll counsel you to look at September of 2018. You'll quickly arrive at the weekly bearish order block that it's traded up into here. We had a market structure break. Price comes back into optimal trade entry, closes in liquidity void right in here, then starts to run lower. After it runs to high here, this is where we're looking to sell. So we're selling external range liquidity. Okay, what do I mean by that? Outside of the range of this low to high, this is where the most present dealing range was prior to this movement above. Yes, there's a range here to here. Okay, I'm not arguing that. The idea is assume for a moment, and I'll let you go to the weekly chart to see this, because I can't give you everything in the lessons, because you have to go into the price action and see it yourself and draw up annotations. So you're going to pull up a weekly chart of the British pound. And this is a 4-hour chart. And again, it's not limited to any one specific time frame. Okay, so have that in your notes for this. The range is this low and this high. We want to see price run above that. Why? Well, it has a liquidity void in here. And price has got to go trading up into what? A premium. It has to trade above an old high, and it has to trade into a premium. So we're seeing the price action move above this high here. We want to be selling short up there. What price level? Well, you can use an institutional level, big figure, mid figure, or the nearest round 10 level, or 5 level, inside of the fair value gap or liquidity void. So I'll let you determine that on your own, okay? And it's not something you're going to submit homework, to me saying, okay, this is what I would have suggested. Study inside this little area in here, between this low and this high, this one singular candle right there. In that range, determine where the 0 level is, the 5 levels, if there's an institutional level at all. And as price would shoot above this old high, the framework for this model, okay, remember, when I'm giving you these price action models, they're not trading systems. They're not trading plans, okay? We lay foundations first to build a premise around it. Okay, before anyone sits down and builds a trading plan, they have to have confidence in a specific pattern or an approach to analyzing the marketplace. So that's what these 12 models are. They're foundations to build on. Okay, when we go into 2020, we will start fleshing out very detailed, specific trading plans for each one of these models, but you have to have a premise first. Now, you could quickly argue with me, well, Michael, you should have just told us this is the premise and then built a trading plan. No, you have these at your disposal, and then you're supposed to go through price action yourself every single day, every single week, and see if you see these characteristics in price action. The one that resonates with you the quickest, the fastest, the easiest for you to see in price, that's the one you're going to work with predominantly. It doesn't mean you're going to stay with that one for your career. It's just that's the one that you see easily right now, and you build on it. Okay, so when price is bearish, okay, and I'm assuming we're all going to agree, and if you look at the weekly chart, you'll quickly see that this is what that was. It was trading up into a bearish order block. Price trades down away from that. Now, we have an old low. We know trading below that, that would be an external range liquidity target. So right below this low, you could be a short covering. You can take partials, or it could be a full, complete exit. If it's not 50 or 75 pips or within that range of 50 to 75 pips, you would hold for lower prices. Because again, the weekly chart's suggesting lower prices, so it's probably not going to stop just here. It's going to want to look for some discount array. So to get to a discount array, what's the parent price swing that it's retracing inside of? This high to this low. Midpoint roughly is here, so it has to go below this price point here to get down to equilibrium and or to a discount. The way this model works is you want to be looking for, when you're short, you want to be looking for swing lows to form and then wait for those swing lows, like this swing low here formed. We started to rally up a little bit. When price broke down here, right below this low, that's where you would take your profits, because you're trading at a external range liquidity pool. You're outside of the defined range from this low to this high. That was the range. It's retracing here, then it breaks out of it. You want to be always taking profits below, on short positions, below old lows, because you don't know if that next low that it runs down below doesn't create that scenario there. This low is formed below equilibrium of this parent price swing here to here. So when this low forms and price trades down below that, that's a perfect opportunity to collapse the trade that you shorted from up here. When we look at price action, you want to be looking for turtle soup scenarios, and that's what really this is. It's turtle soup. You understand the optimal trade entry. You understand fair value gap entries. You understand equal highs being blown out as a target for long positions. You understand equal lows being blown out for a short position and targeting that. If we change gears a little bit and start incorporating external range liquidity, you can start learning to trust selling short above old highs and buying below old lows. This gets you in the habit of looking for entries and exits, and they're opposing in nature. You're looking for external range or turtle soup shorts to go short, and then turtle soup longs to cover. So you want to be, your rules are simply this. You cannot sell short unless you're selling short above a previous short-term high. In that short position, you cannot cover unless you cover below an old low or a new short-term low. As it forms here, price runs away and then trades down below it. Right below here, that's where you would collapse the trade. It's as simple as that. Now, partials, it's very simple with this. Once you enter, on the time frame you enter on, this is a 4-hour chart. Again, now this is something that a lot of you that are thirsty for these position trade ideas, this is a wonderful opportunity for it because it gives you logical levels to collapse your partial position. Once we trade below this low here, take a partial off. Price trades down lower, creates a short-term low, it spikes up. Maybe you got nervous this day, maybe you didn't. You know right below this low, you're going to take another portion off. It trades below it here, you take a portion of it off. Price comes down, creates another short-term low, it rallies up. You know if it trades below this low here, we're in a discount, and it's an area to take profit. Take your final portion off there. You don't suffer anything on this. Okay? If you were so inclined to take a long in here and using this turtle soup as an entry going long, you would be buying below the old low, and you cannot sell the completeness of the position. In other words, you can't collapse the entire position or whatever we remaining after partials unless you sell it above an old high. So as price creates this short-term high here, you can take partials out right there. Price runs up, creates a short-term high. When price runs above it on this candle, you take a partial here. Look over here, you have this old high here. If price trades above that high here, you collapse it. Now you can hold for this movement here or trade your stop loss up, and it has to be, if you take two partials, you have to be really, really tight on your trailed position or trailed stop loss rather. You do not want to be ultra short term in like 5 pip stop losses or 10 pip stop losses. Don't even think like that. But once you take two partials, you want to really be protecting the open position at that point, because after two partials, generally that's kind of, just think like 3 drives pattern where it creates a high, a higher high, and a higher high, and then a rejection occurs and it has like typically an intermediate term high forms. Well, you can see that almost forming here. You have a short-term high, a short-term high, and a short-term high. It runs through that and it creates little tiny ones in here, but until it presses above this high, all these are insignificant in my mind. But once we get above this high, this short-term high, then this short-term high, and this little spike here, all of this I would have not been in. I would have been just out right above this high here on this candle and been done with it. So in your rules, you want to say that two partials on the third take profit, all your position comes off. It's as simple as that. If you don't like that rule, you can change it where you take one partial and your second exit is the remaining portion. You can do that as well. If you look at the amount of pips here, it's not 50 to 75. I elected to use the 4-hour chart just to remind the folks that we're not day trading all the time and we're not using the information just to day trade or scalp. This works on all time frames. So since I've included the 4-hour, let's go over to MT4 and we'll work with a 15-minute time frame using cable. And you can see how it works inside of the weekly range and on an intraday basis. Okay, so without going into all the running off at the mouth about why cable was bearish, just look at the market commentary for the week of February 15th to Friday. So the analysis that was shared prior to that, we obviously mapped this out for bearishness. So if you were looking at this later on and you finally got to this lesson, we're not cherry picking. Just go back and look at February 15th, that Friday. Look at the market analysis for that week, the Monday and the Wednesday analysis for 2019's February 15th week ending commentary for cable. Okay, so I just want to preface it with all of that. So from a visual standpoint, over here, this is what you're looking at. You want to see an area where there is a single high or double high. In other words, like a double top. Either one of these scenarios will work when you're bearish. When price runs above that, and it's during a kill zone, and it's a time of day where it would support it. In other words, we're in a bearish market environment. It's London Open or it's New York Open, and it's day of the week that will promote a continuation down. In other words, ideally on Monday, Tuesday, or Wednesday when it's a weekly bearish scenario. That's ideal. And then trading down into an old low, or it could be a double bottom. Think of the euro dollar. I'll just toss this in here just for completeness, like this. Okay. I just want to include this. I was trying to use this very pattern and model to do euro dollar because I anticipated doing Monday's release of model number 10, but again, my wife needs us to do things Monday, so I'm doing model number 10 release Saturday, February 16, 2019. But I wanted to sell short above here and then cover below this low here. But it created a double bottom, which is even better, and you saw me actually engage selling short here using this run above this old high. I sold short here, and I targeted these lows. So I absolutely used model number 10 this week in Eurodollar, and you saw that on Twitter. So going back over to our cable example, just know that the double top and double bottom are included only in the visual representation of what you're doing with the price action model, but it doesn't have to require, or it doesn't rather require double tops or double bottoms. It could be a single high and a single low that it runs stops on. The premise is the bias. So we're anticipating a run on stops, and we're practicing and studying when price does that very thing. So you want to be a short seller above, when you're bearish, above an old high or a double top, selling short there and then waiting for a low to be violated and then covering there. Okay. Ideally, you want to do it, and again, during a kill zone, which would be ideal for if you're day trading, London close, and or if you're one shot, one kill trading, you want to be doing the cover generally on Thursdays at New York Open, because that typically will make the low of the week when we're bearish. In bullish weeks, it would be reverse of this diagram. Okay, so everything would be reversed, and I'm not going to include that here. I want you to draw this out in reverse. So you're going to have a low and a lower low, then the price run up, creating a high, another high, and then it runs above it. So everything here just reversed or upside down, okay? And you'll have it for being a buyer. So I'm only giving you the sell side here because we have examples to use in the cable price action this week, and I want you to study this week because I'll give you something for the buy side using this model next Saturday. So it kind of like evens out the model. So we have two schools of thought here. If you're a 50 pip target trader or a 75 pip target trader, what we're looking for, put our day dividers in. Here's Sunday, the opening price, which we're not going to include all the lipstick on this, but we want to see price trade above the opening price. Here's Wednesday, it does that. It does so in the form of running above an old high. In an environment where we're already bearish, expecting lower prices, the ideal scenario is that we want to sell when price is running the opposite direction of our bearish stance. Running above an old high, ideal scenario. So we can see, and you really want to practice this on paper for a while because it's a little scary at first, but over time, you'll build your confidence up, and you'll see that these movements are pretty responsive. 10 pips above, 15 to 20, 30 pips above. You're looking for those opportunities, but we're running above an equal high back here. So look at it like this. Run above. You want to sell short there. Price breaks down. Once price takes out this short-term low here, you can take a partial there. Market trades down, creates a short-term low here, starts to run up. If price takes out this low, we can take another partial. Or it could be your first partial, because you would anticipate maybe this low being your second. But because we create this short-term low so close, we could look for a little bit lower objective. And remember, we had our weekly liquidity pool down around that 128 big figure for the week of February 15, 2019. And again, watch the videos for that particular week in your archive, and you'll see we had all that mapped out beforehand. So every time we create a new low and it trades below it, you're taking potentially a partial off. Now, remember the rules I just gave a couple minutes ago. On your second partial, the next time you take profit, you have to be out of the entire position. So it gives you an opportunity to map out, as every time we create another short-term low ahead of our ultimate objective of 128 big figure or lower potentially, because every time we trade to a big figure and we're trading down to it, it could trade 10, 20, or 30 pips below the big figure. Okay, so that means the 90 level, the 80 level, and the 70 level below the big figure are potential candidates how far it can reach down. I very rarely hold on to anything beyond 20 pips below the big figure. It's just me. I like to do that, and maybe you'll do it better than me. But in here, beautiful example of using the model, but we have to get out below an old low to cover it. And by doing this, even if you go back and you mark up your charts, say you don't trade with this model, you should look for these in your price action study every single day. Draw them out on your chart. By doing it, you're building experience internally, and you're activating your reticular activating system, where it allows you, when you look at price action, you'll remember, hey, I remember seeing that because I did it 20,000 times. You'll see it live as it forms, and you'll start saying, okay, we're below that low. I'm going to paper trade the idea that I'm going to be buying here or selling here, and I'm going to wait for these short-term lows to form. Every time it does and it trades below it, I would take a portion off. Now, I'm going to leave it up to you what the percentages of the scaling out you would use, because I don't want to have everything outlined in my personal opinion. Partials are completely personal. You could take 50% off on your first one, then 25, and then balance out the last 25% of your original position on your final collapse. You only take 3 profits. Okay, the third one, the trade is collapsed or you're stopped. It's simple as that. Okay, so it's not a very complicated model. It's rather simplistic. It's easy. It really is easy. So I'm going to pull up a Canadian dollar, and I don't know right away what it's going to show, but we'll just see if we have some examples here. All right, so we have equal lows here. Price trades down below those. We can be a buyer, and you cannot sell unless we take out a short-term high. This is too close. We wouldn't want to do anything with that. We want to see it try to get back above the point that defines the setup, which is these lows here. We traded down below it. So when we trade above here, if we get above this high, which it does here, first partial. Price trades down, rallies up. It creates a short-term high right here. So if price trades above that, we can take a partial. Price trades down like here and trades right back up right here. You can take another partial, or unless it's too close for you, you want to see it run back up into this area here. You can see it do it with this short-term high. We run above it, and there's your third partial, and you're out. And that's really a nice run, because it takes us right back to the bottom of this consolidation, which could end the run here. It could have very easily stopped there and traded down deeper. Right away, you can see how this pattern or model gives you structure, it gives you framework, and it's a very easy rule-based idea. Here's another example. We have price trading above these equal highs right here. You can be a seller, selling, waiting for it to trade below, right below this low here, first partial. Price trades a short-term low here, trades down below it, and also we could see this low here, double bottom, trade below that, take a partial. Creates a short-term low here, trades down below it again. Maybe it's so close we don't really want to take any more that close. We want to see if we can get a run a little bit deeper. Any short-term low that creates here, we could take our cover right there on the third position, exit, and collapse. The pattern is very, very versatile. It's so generic, it can be used on any time frame, absolutely any time frame. As a day trading model, you saw it right here. As a one shot, one kill, if we go back to cable, if we want to be a seller up here, and 50 pips is your model target, and you sell above, if you're selling above this high here, we'll say you're just selling it a few pips above the equal highs over here. We're selling it right in here. So we're not getting the actual high. I can make this look cherry picked, and this is the best entry point. We're not trying to do that. Entering here, even before we get below the low that would create the breaker, we're already at 50 pips. If we use 75 pips as our model, using roughly the same entry right in here, we get below that low, and we don't even have to worry about all this extra move. We got 75 pips banked, just like that. That's one shot, one kill. You're done. It's over. Now, obviously, you could structure it so your first profit is, if your model is 50 pips for the week, you take half off at 25 pips, and then you scale at 75 pips and leave a portion on in case you get a runner. Or you can do a small exit at 25 pips, like say 25% of your position, and leave 75% on, and then when you get 50 pips, take another quarter off, and then the last portion is full profit for the remaining half of the original position. That's one scenario. We can do that as well. But the model itself is very, very elementary. It's simple because you're running old highs, selling short there, and you're waiting for price to trade down into a new short-term low or an old low to the left. Old lows to the left take precedence over new short-term low. The liquidity, for instance, like we created the short-term low here, trading below that, it's not as ideal because you have an old low back here. The liquidity is resting below here. This is a big pocket of liquidity. Why? Because we have movement away from it. It hasn't been back to this price point in a while. So this short-term low here, after seeing a run above this and coming back down, you want to try to hold something on to get below that low, and we get it here. Look how much energy it takes to trade down into that. Hits it here, small little retracement, sells off again, optimal trade entry, sells off one more time, and hits the objective pretty much almost to the pip that we were looking for this particular week. And then we have a run higher. We can see the same thing occurring here after we create our low of the week scenario. TGIF conditions, we have equal lows, price trades down below it, we can be a buyer there. Price runs up, creates a short-term high, retraces, runs through it, take profits there. Next short-term high is here, you can take a partial out there, and the other high is here. If it trades out there, we're collapsing the position, it's over. I promise you, if you don't see it, watching it with me right now, go through your charts. Watch the video a couple times. I'm going to end it here. I don't want to add any more rules to it because it's not necessary. How much you take off at your partials is completely up to you. You flesh that out yourself. I gave you several suggestions in this teaching where it can be done and how to structure it. The buys and the sells, I give you both sides of it. Now, next Saturday, I'll give you a sell side which has the complete diagram over here to help you see it visually. But right now, I want you to study this week, go through your charts, and find 10 examples. I don't want you sending them to me in my email. I get thousands of emails every week, and it's very hard for me to keep up with them. But I want you to find 10 examples and store them in your study journal. And we'll come back to them next Saturday. And we'll do 10 examples of buy side using this model for next week's homework. But if you're excited, you want to look for if you want to find 10 buy examples in addition to your 10 sell examples using this model. Spread it out also. Don't just do Forex. Look at a few stocks. Look at the commodities. Okay, and you'll see that this model is everywhere. And it will help you train your eye using external range liquidity for entry and exits. And it gives you a wonderful framework for trading outside the core liquidity that's seen with a range-bound market. Like this would be a range high, and this would be a range low. Trading outside of the range and outside of the range and using those as your entry and exit point, that's the apex of predatorial trading as far as I'm concerned. You can see outside of the candles the narrative, where the liquidity is, the open float above and the open float below the current market price. Even if you don't trade this model, study every single day looking for this example. Map it out. I promise you, if you do this every single day, you will very likely grow into this being a model that you like to use, okay, or at least frame out your setups. It's certainly going to help with you taking profits because it's a very clear-cut strategy. You know what you're doing. You're exiting short positions below newly created short-term lows and or old lows. It's very, very simple. When you're long, you're selling out of the long position above newly short-term created highs or old highs. You have to exit above a new short-term high or an old high when you're long, or you have to exit on short covering for a short position below a newly short-term created low or an old low. And that you're getting in buy stops and you're getting out on sell stops, or you're getting in at sell stops and getting out at buy stops. You're using counterparty liquidity theory for your entire model. So hopefully you found this insightful. Until next time, wish you good luck and good trading.